I've seen Netflix stock drop by 50% or more on 3 different occasions since I've owned it, including a 70% crash in 2022. I'm currently sitting 29% below the highs that we saw back in June. In this video, I'll show you why I'm not panic selling right now, what it would actually take for me to want to sell the stock, and the figures I'm going to be watching going forward to decide whether or not I want to buy more. Before we touch the most recent quarter, I want to zoom out and look at what Netflix stock has actually done over time. The goal is to put this 29% drop into some context, and as you can see here, Netflix stock has never been a smooth ride. You don't get big long-term returns in this name without sitting through some brutal downturns. 3 I want to highlight right now. You see in 2011, that was a big one where it declined over 70% in just a few months from July to November of 2011. And that one was when the business was transitioning from DVD by mail into instant streaming. Then we had another one that declined in 2018 after setting a high of around $41 a share, down 45% or so. It took almost 2 years before that was able to recover. And then the big one, of course, happened in 2022. This is in the context of the NASDAQ declining sharply. So all tech stocks got hurt pretty hard, but Netflix really got hammered and shares fell by 75% from the highs in just a few months. This is from October to May in 2022, and it took several years before the company was able to recover. And for context, I've been a shareholder through all of that. I first bought Netflix stock in May of 2008. It was just a really tiny position. I was just starting investing for $210. That one purchase is worth over $47,000 for me right now, and it's a huge part of my portfolio. So when Netflix moves, I feel it. So here's where we stand today. We're down 29% from that June 2025 high. The real question is, does this pullback look like the previous ones where we eventually saw new all-time highs, or is something actually breaking with the business? To answer that, we need to look at what management just reported and what the financials say underneath. Let's start with that shareholder letter. One big takeaway right at the top here, management says we continue to project 2026 revenue of between 51 and 52 billion roughly, and an operating profit margin of 31.5% of sales. Neither of those figures changed since 3 months ago, and I think that's a big reason that why the stock is being weighed down. I think a lot of Wall Street investors were hoping that at least the operating profit margin would be boosted because the company's not spending $80 billion buying Warner Brothers and all those associated costs that come along with it. But a couple other big highlights. Growth was 16.2%. That's strong. That's actually on the top end of management's guidance of between 14 and 16% growth for 2026. Operating profit margin is also fantastic, 32.3% of sales, climbing up towards that 35% rate, above the 31.5% goal that management forecast for the year. And then earnings more than doubled, mainly because of the breakup fee with Warner Brothers. But we can see that the company did forecast a slowdown in growth ahead for Q2 to 13.5%. And operating margin is going to decline from 34% of sales a year ago to 32.5% in Q2. This is lumpy stuff, though. It's not anything investors need to be worried about. Management is forecasting acceleration in the second half of the year, so the company is going to hit its overall goals on both revenue and operating profit margin. A couple other big highlights here. The company says our goal is threefold. They want to sustain healthy revenue growth, expand operating profit margin, and deliver growing free cash flow. We're going to look at all 3 of those figures in a second when we dive into the 10Q report. And finally, management does say that they have set a new engagement record so far. They are extremely excited about the growth opportunities ahead. Management says we're still incredibly small. We account for an estimated 5% or so of TV viewing globally. That's closer to 9% in the US market. And as of the end of 2025, we penetrated less than 45% of total addressable market of broadband households. So either one of those figures, basically any way you look at it, Netflix does have a huge growth runway ahead. And as they mentioned in engagement, they said this is a huge number for the business. It's probably the most important figure because it feeds into revenue growth, it feeds into membership growth, it feeds into churn, and it feeds into the pricing that management can charge. In Q1, they said we made good progress as our primary internal quality metric reached an all-time high. So my big takeaway from the shareholder letter is good news for the business, record engagement, however, no upgraded outlook for 2026. So let's dive into that 10Q report. The 10Q filing was over 30 pages long and more than 20,000 words. Pretty dry reading, but I went through it and highlighted it so that you don't have to. Some of the big takeaways here, the main one here I want to mention is management says our core strategy is to grow the business globally within the parameters of our operating margin target. That flips it on the head from a lot of other businesses. They want to grow quickly and then expand profit margins because of the growth. In Netflix's case, they target an operating profit margin and then grow as fast as they can within that range. So it's just a lever they can pull. So the operating margin is basically the steady one, and then growth is the range that we're going to see change from quarter to quarter. So we do see that 14% growth so far for the first quarter of 2021, and that's 16% is the figure that we saw in the shareholder letter, but after you account for currency exchange rate swings, that number is more like 14%. And we saw operating income grow at a faster rate, 18%, and that's why operating profit margin increased by about 1 percentage point from 31.7% of sales to 32.3%. And management says the reason why net income almost doubled, went up 83%, was because of the $2.8 billion termination fee that they received in connection with the breakup of the Warner Brothers Discovery purchase. And we can see here growth by region. I think this is a very important metric to watch here. Overall is at 16% growth, but the US market, the most mature market and the biggest market, it's worth almost half of Netflix's annual sales, grew at a slower pace of about 14%, and I think that's another big yellow flag that we're going to be wanting to watch over the next several quarters. The other regions were stronger, 17% in Europe, Middle East, and Africa. Latin America is growing at almost a 20% rate, and so is the Asia Pacific market, growing at a 20% rate. And management did say that that was mainly because they did a really big live event in Japan, and that really boosted sales for the quarter because there were a lot of new signups there. Just a few highlights of the costs to see why the company was able to boost overall operating profit margin. Cost of revenue declined from 50% of sales to 48%. Sales and marketing stayed steady at 7% of sales, so no change there. Same thing with the tech and development, the other big expense that they have. However, G&A, general and administrative costs, went up from 4% to 5%. I think this was a surprise too. Many investors didn't want to see this. That went up 43%, and that was because management says higher legal fees and transaction costs, including those associated with the Warner Brothers transaction. So I think this is one of those places where they pulled forward some expenses into 2026 from 2027, and that's another reason why I think the operating profit margin did not increase. The forecast didn't increase anyway. And then interest expense stayed at 2% of revenue, but here we saw a 5,500% increase in other income, and this is where management put the $2.8 billion of extra cash that they received from that breakup fee. And that very small line item was very big this quarter, and it's going to be obviously a one-time event. Looking finally at cash flow here, cash was up 36%, and then mainly thanks to that $2.8 billion fee. So that went up from $9 billion on the books to $12.3 billion. So management does have a lot more cash to work with. And they do say that that's mainly because of the $2.8 billion termination fee. And finally, the company repurchased just 13 million shares for $1.3 billion in the quarter. That's roughly $2.2 billion fewer than they spent a year ago. And that, they said, was because they were planning to do that $80 billion purchase of Warner Brothers. And now that they're not doing it, I think management's definitely going to increase their spending on repurchasing the stock. And that's great news for investors like myself. So where do I stand on the business? I want to give you 3 big reasons to like it and then one thing worth watching going forward. The first bullish factor is that operating profit margin. Yes, 31.5% of sales is the projection, and that has not changed in the last 3 months. However, we're still talking about a record for this business, well over 20% of sales, and a nice improvement over last year's 30%. The second big reason to like this business is engagement is sitting in that all-time high. And the number I keep coming back to is that 5%, which is the percentage of overall TV viewing in the globe that Netflix is responsible for. If you compare that to the US business, which is sitting at around 9%, if the company can get anywhere close to 9%, which is in its most mature market globally, then I think the runway for growth is huge. And the third reason to really like this business is how cash rich it is. Cash flow is improving, even if you take out the $2.8 billion fee that the company just got. And I think that means more stock buybacks and potentially a dividend down the road. Now, the one thing to watch out for is the US business that's growing at a 14% rate. If it continues to slow down, I think that means that competition is eating into Netflix's growth potential, and that would be a reason for the stock to continue to decline from here. So I'm holding the stock and not selling a single share right now. A 29% pullback on a company that's seeing record operating profit margin, record engagement levels, and has a huge runway for growth is not something that scares me as a long-term investor. I'm also not adding to my position though because it already accounts for a big portion of my portfolio and my overall net worth. So I want to watch over the next few quarters how subscriber trends go, particularly in the US market. But selling, not a chance. If you want to see exactly what Netflix has meant to my overall portfolio, including how it helped my net worth get over $1 million, I put together a video walking through the 5 biggest purchases that helped get me there. Check out that video next and I'll see you over there.